Shalom class, welcome to Innocent MAPANDA tutorials. In today's lesson we are going to focus on June 2019 paper 1 advanced level accounting Zimsec. Right, we are going to start with question number 1. It reads, why do businesses charge depreciation on their non-current assets? Option A, to ensure that the funds are available for asset replacement. So option A is wrong. Why? Because depreciation is a non-cash item. So if there is the word funds, it means depreciation does not qualify. Right. Then we move on to part B. To show the realizable values of the assets in the statement of financial position. This is wrong. Why? Because this is against the going concern concept. Going concern concept says that if the business continues to, it must reflect its assets at cost, less accumulated depreciation. So it means C is also wrong. I hope you are following. So the correct answer is, we charge depreciation in order to spread the cost of the asset over their useful lives. We move on to question number 2. The financial statements of a limited company contains the following items. Number 1, profit for the year. Number 2, profit on disposal of non-current assets. Number 3, rights issue of ordinary shares. Then number 4, taxation. Right. Which items would be found in the statement of changes in equity? So in the statement of changes in equity, you find profit for the year. You also find rights issue of ordinary shares. Right. So taxation and the profit on disposal are all adjusted in the profit for the year. So we are left out with only 1 and 3. So the correct answer is 1 and 3, which is B. Then we move on to question number 3. It reads, a company with an existing issued share capital of 500,000 ordinary shares of $1 each made a bonus issue of 1 share for every 5 years. So it means 1 over 5 times existing number of shares, you'll be able to identify the bonus shares. So 1 over 5 times 500,000, you get what? You get 100,000 shares. So these are shares made by the bonus. I hope you are following. Right. So let me indicate this is bonus shares. Then we move on to sentence number 2. This was later followed by a rights issue, right, of 1 share for every 3 held at par. Right. So 1 over 3 times. So for rights issue, don't multiply by 500,000, right? But you multiply by 500,000 plus 100,000 bonus shares which were added. So the new existing number of shares is now 600. So 1 over 3 is going to multiply 600,000. You get 200,000, and this 200,000 represents rights issue shares in terms of number. I hope you are following. Here comes the question. What was the balance on the share capital account after these transactions? So the share capital account, right, is calculated using the par value only. So we have to calculate the total number of shares that we now have after these transactions. Then we multiply by the par value given of $1, right? So remember, before the transactions, we had 500,000, which was given by the question here. 500,000 is going to be added by 100,000 of bonus as well as 200,000 of rights. 5 plus 1 plus 2, you get a total of 800,000 shares to be multiplied by the par value of $. It means the ordinary share capital account after these transactions is going to sit at 800,000. And our option here is D. I hope you are following. We move on to question number 4. The following information is extracted from the financial results of Zeno Limited. Right? What is the price earnings ratio? So price earnings ratio is the reciprocal of earnings yield. Right? I want you to understand something. If you are asked to calculate earnings yield, right? Earnings yield is equal to earnings per share divided by market price per share times 100. So price earnings ratio, the required, is going to be calculated by reciprocating the earnings yield ratio. So it means MPS, which was the denominator, becomes the numerator, and EPS, which was the numerator, becomes your denominator. You get your price earnings ratio. But you don't multiply by 100, since price earnings ratio is given as number of times and not as a percentage. So the market price per share is going to be provided by the question. We are given the market price of an ordinary share was $30. So I'm going to put $30 for the MPS. I now need to calculate the EPS. So EPS is calculated by the formula earnings divided by number of ordinary shares. Earnings divided by number of ordinary shares. So in order to calculate the earnings, you take operating profit first. Then you have to deduct 3 items from the operating profit, which are interest, tax, as well as the preference dividends. Then you divide by the number of ordinary shares. I hope you are following. Right. So our operating profit, we are given profit after tax and interest is 750,000. So I'm going to write 750,000. This 750,000 covers OP minus I minus tax, since it is after interest and tax. So just need to less the preference dividends. And the preference dividends paid here are given as 120,000. Remember, according to the new international accounting standards, right, in the statement of changes in equity, we now record dividends paid only. Proposed dividends are no longer recorded in the income statement, are no longer recorded in the statement of changes in equity. However, they are just disclosed as a note. I hope you are following. So I'm going to use the amount given of 120,000, the preference dividends, right? But if this figure is not given, you multiply 8% with 1.5 million to get the preference dividends. So 170,000 is going to be deducted by 120,000, right? Then you divide by the number of ordinary shares. So be very careful when it comes to the number of ordinary shares. The number of ordinary shares does not represent this amount given on the right side. Remember, this amount given on the right side is 4 million. This is not the number of ordinary shares, but this is the value of ordinary shares. So to obtain the number of ordinary shares, you divide the value by the given par value. And the given par value of ordinary shares is $10 each. I hope you are following, guys. So what is 10 into 4 million? 10 into 4 million, you get 400,000. So I'm going to divide everything by 400,000. I hope you are following. So 750 minus 120. You start by getting 630,000. Divide this by 400,000. So if I divide 630,000 by 400,000, you get 1,575 per share. So this is the EPS, or the earnings per share, right? Which is going to represent my denominator here. So I'm going to put 1,575. So 30 divided by 1,575, what do you get? 19.05%. Then, since our answers are given as a whole number, rounding 19.05% as a whole number, you get 19% as your answer. So I'm going for option A. I hope you are following. I want you to stay tuned as we move on to question number 5. Taru Limited provided the following information. What is the return on capital employed? Return on capital employed is also known as the ROS. It is calculated by the formula operating profit, right? Divided by capital employed. Divided by capital employed. Then you multiply by 100. I hope you are following. So operating profit is given by the question as profit from operations, which is 120,000. So I'm going to put 120,000 on my numerator. Then capital employed is found by the formula equity plus FCC, where FCC denotes the fixed cost capital, right? Or it can be found by the formula fixed assets plus current assets minus current liabilities. So you have to know both, right? Fixed assets plus current assets minus current liabilities is equivalent to equity plus FCC. So according to this question, we are using equity plus FCC since it is the given information. So the equity here is 600,000. I'm going to write 600,000 as my equity. Then fixed cost capital is made up of long-term loans, debentures, and preference share capital. So the long-term loan or the debentures is represented by 200,000. We don't have preference shares here. If we add preference shares, we're going to add the 2 to get the total FCC. So I'm going to multiply this by 100. I hope you are following. So it's 120,000 divided by 800,000. Then you multiply by 100. So 120 divided by 800 times 100, you get 15%. So our option here is C. Then you are home and dry. We move on to question number 6. The table shows details of freehold property of a company. We are given the historical cost, which is 100,000, as well as the accumulated depreciation. The property has been revalued to 120,000. So the journal entries for revaluation are very simple. What you need to understand is when an asset is revalued, depreciation or accumulated depreciation, which was previously charged for the previous years before the revaluation took place, must be written off, right? So I want you to understand that provision for depreciation account, which is also known as accumulated depreciation, has a credit balance. To write off that credit balance, I'm referring to this 30,000 here. This 30,000 has a credit balance. So since we have revalued our asset, we need to get rid of that accumulated depreciation by debiting the accumulated depreciation. So I'm going to debit provision for depreciation account by 30,000 to get rid of the accumulated depreciation. I hope you are following. After that, you compare the historical cost of the asset with the revalued amount. If the revalued amount is above the cost of the asset, you debit the property. But if the revalued amount is below the historical cost, you credit the property by the difference between the cost and the revalued amount. So here, the revalued amount is 120 and the cost was 100, reflecting an increase in cost of 20,000. So I'm going to debit 20,000, right, representing my freehold freehold property, something like this. Then 30 plus 20, you get 50,000. And this 50,000, it represents the revaluation reserve. I hope you are following. So this is how you prepare the journal entries. So our answer here is B. Since on B we have debited property by 20, provision for depreciation by 30, and we have revaluation reserve of 50 on our credit side. I hope you are following in class. Right. We move on to question number 7. It reads, a trial balance failed to agree and a suspense account was created. It was found that discount allowed 400 and the discount received 300 have both been entered on the wrong side of their ledger accounts. What is the double entry to correct errors? So I'm going to open discount allowed, then I also open discount received. I hope you are following. So discount allowed is an expense. Know that. Discount received denotes income. So expenses are debited, incomes are credited. So if those amounts were posted on the wrong side of their ledger accounts, it simply means that this discount allowed of 400 was credited in the discount allowed instead of being debited, since discount allowed denotes an expense. This discount received of 300 was debited in error instead of being credited, since it was income. So this 400 denotes error, this 300 denotes error. We now want to correct the errors. So to correct the discount allowed account, we need to put double amounts. The first 400 is there to cancel off the credited 400. Then the other 400 is there to then debit the discount allowed. So discount allowed account has been corrected by a total of 800 on the debit side. We move on to discount received. We need 300 to cancel the debited error of 300, then another 300 to credit the income. So discount received is going to be corrected by a total of 600 on the credit side. So here is our journal entry. Debit discount allowed by 800, which is the total. Then credit discount received by 600. So for the debit to agree with the credit, a difference of 200 is going to be credited, which represents the suspense account. So this is how you prepare your journal entry. So let us look on our answers here. Debit discount allowed by 800, credit discount received by 600, and suspense of 200. So it means our option is B. I hope you are following. We move on to question number 8. A company sold a motor vehicle and the following is shown. Original cost 40,000, accumulated depreciation at the date of sale 10,000, loss on sale 5,000. What were the proceeds? Remember, the proceeds, they are referring to the amount that we received in either by check or by cash when we sold the vehicle. To find this amount, you prepare a disposal account. I hope you are following. So in the disposal account, cost of the vehicle is debited. So I'm going to debit 40,000. I hope you are following. Then accumulated depreciation is credited together with the bank or cash received. So accumulated is going to be credited by 10,000. Then the bank is unknown to come out as a balancing figure. Loss is credited. If it was profit, you put profit on the debit, but here we have a loss of 5,000, which is credited. So to find the bank balance, add the debit total, you get 40, then you put 40,000 on both sides. So 40 minus 5 minus 10, you get a balancing figure of 25,000 on the bank balance. So my answer here is C. We move on to question number 9. It reads, a business buys a machine for 100,000 and depreciates it at 10% per year using reducing balance method. What is the depreciation charge for the third year? So the question is not asking you to find the accumulated depreciation at the end of the third year, but it is asking you to find the depreciation that was charged in the income statement on the third year. Right. So on the year 1, depreciation for straight line and reducing are similar. So I simply multiply 10% by the cost of the asset, which is 100,000. So 10% times 100,000, you get a depreciation of 10,000. I hope you are following class. We now move on to year number 2. For year number 2, it's 10% times cost minus provision. So 10% times the cost of the asset is 100,000. Provision denotes the accumulated depreciation charged for that asset in the previous years. And in the previous year, we charged 10,000. So this is now 10% of 90,000. So 10% of 90,000, what do you get? You get 9,000. This is the depreciation charge in the second year. We move on to the third year, which is the requirement of the question. Remember, according to reducing balance, we say R% times cost minus provision. So the cost remains at 100,000. But the provision here is now the total of year 1 and year 2. So in year 1, we charged 10,000. In year 2, we charged 9,000. So for accumulated depreciation, you add 10 plus 9, it gives you a total of 19,000. So 100,000 minus 19, you get 81,000. 10% of 81,000, you get 8,100. So my answer is B, 8.1, which is the depreciation in the third year. But if it comes like, what is the accumulated depreciation for the third year? If the question asks you to find the accumulated depreciation for the third year, you then need to add 10,000, which was charged in year 1, plus 9,000, which was charged in year 2, plus 8.1, which was charged in year 3. The total of those three, you get your accumulated. But the question is requiring 8.1, the charge for the year in the third. Let us move on to question number 10. What will increase a company's gearing? Right. So remember, gearing ratio is found by the formula fixed cost capital divided by capital employed, which is fixed cost capital plus what? Plus equity. Then you multiply by what? By 100. I hope you are following. Right. So to increase the gearing is either you increase the numerator or you decrease the denominator. Increasing the numerator will increase the gearing. Decreasing the denominator will increase the gearing. So on our answers, we want to find an answer which either increase the numerator or decrease the denominator. I hope you are following. Right, number 1, any issue of ordinary shares. So if we issue ordinary shares, the denominator is going to increase since ordinary shares are part of equity. So if we increase the denominator, the gearing ratio is reduced. So A is not the answer. Issue preference shares. Remember, preference shares are part of the fixed cost capital, which is a possible candidate. Redemption of debentures. Redemption is the decrease of debentures. So decreasing debentures is going to decrease FCC, which is against what we want. So this is wrong, and also D is wrong. Repayment of a loan decreases the FCC as well. So our answer is issue of preference shares, B. We are now moving on to question number 11. It reads, the sales ledger control account for the year ended shows the following. Then we are given the list of balances there. The question reads, how much cash did the company receive from its trade receivables during the year? So for this one, you prepare a sales ledger control account, right? Then start by posting the opening balances. So you have a BD on the debit and a BD on the credit. So the BD on the debit is 30,000, which is our main balance, and the BD on the credit is 5,000. So 5,000, the BD on the credit. Sometimes it denotes an overpayment which was done by a customer, and the refund has not yet been given to the customer, or returns inwards which were overlooked. So not recording returns inwards or omitting returns inwards, or a customer is overpaid and we have not yet refunded the customer, right? It causes a BD to appear on the credit side of the sales ledger control account, and it denotes a current liability. I hope you are following. Right. Our cash, which is required by the question, is going to come on the credit side as a balancing figure. Take note of that. Right. Transactions for the year, we are given sales invoices. Sales invoices, they denote what we call credit sales. So credit sales, they appear on the debit side. So I'm going to put 50,000 on the debit side of the sales ledger control account. Discount allowed 1.5. So discount allowed is going to be credited. You put 1,500 on the credit side. I hope you are following. Then debit notes, they represent returns outwards. But if we were given credit notes, we are going to record the credit notes as returns inwards on the credit side. So this one, I'm going to leave it like that. Since returns outwards, they do not appear in the sales ledger control account. Right. Purchases ledger contra. Contra, it means contra set off. It appears on the credit side of the sales ledger. So the contra here is 4,000. I hope you are following. Then closing balances are posted on the opposite side. If you are given a closing balance like a debit of 20, you post the CD on the credit side of the sales ledger control. So 20,000 is posted on the credit side. Why posting it on the credit side? Because if we then bring that CD down, it will then appear on the debit side mentioned. I hope you are following. Same applies. If we were given a credit balance, you are going to post the CD on the debit, so that if you then bring that CD down, it will then appear on the credit mentioned. So balance CDs, you put them on the opposite side. If you are given a balance CD of debit, you put it on the credit, so that it will then reflect on the debit after being brought down. Right. So 30 plus 50, you get a total of 80,000. Then 80,000 minus 20,000 minus 4,000 minus 1.5 minus 5,000, you get a balancing figure of 49,500. So this gives us option A as our answer. I hope you are following, class. We move on to question number 12. A cash book of a business shows a debt balance of 40,000, right? The following information is provided. We are given deposits not credited. These are undeposited checks or bank lodgements. Amount debited to the business bank account in error. So this is a correction to be done in the bank statement. Bank charges for the month, they are recorded in the updated cash book, as well as the dishonored check, we record them in the updated cash book. So the first thing to do is let us update our cash book. So I'm going to prepare updated cash book first. All right. So a cash book of a business shows a debit balance of 40. So I'm going to put 40,000 on the debit side. All right. Of the information given, bank charges and dishonored checks, they appear in the updated cash book on the credit side, since they refers to payments. So we have a bank charge here of 50. Bank charges of 50. We also have a dishonored check of 2,000. I hope you are following. Something like this. So 40,000 and 40,000 are posted in the totals. So 40,000 minus 2,000 minus 50, you get 37,950, representing your balance CD to be brought down as 37,950 here on the debit side. I hope you are following. Right. So after that, I need to prepare the bank reconciliation statement. I normally use this format since it will then tell you whether the balances by bank statement is on the debit side or on the credit side. Right. So here I'm going to start with the balance as per cash book. Balance as per cash book. This is going to appear on the debit side, 37,950. I hope you are following. Then after that, I need to record the undeposited checks. So undeposited checks we less. So if we less undeposited checks, it means we are going to post them on the credit side. That's why they are denoted as deposits, not credited. So we are now crediting them in the bank reconciliation on the credit side. I hope you are following. Then we add unpresented checks. I hope you are following. So unpresented checks here were not given. They are not there. So there is a 0. I hope you are following. Right. So there is an error which took place in the bank account, which is note number 2. Amount debited to the business bank account in error. So it means in the bank reconciliation in the bank statement, right, on the debit side, the bank debited 500, which was not supposed to be there. So to cancel off this 500, you have to put another 500 on the credit side to cancel off the 500 on the debit. So let us write here is error corrected. So to correct this error, put a 500, right, on the credit side. Then after that, you skip one line both sides, something like this. The bigger total is 37,950. So you write 37,950 in totals. Then balance as per bank statement would then appear as a balancing figure. So 37,950 minus 500 minus 3,500, you get 33,950. And our option is A. Then you are home and dry. Let us move on to question number 13. Right, it reads, the following information is extracted from the books of Roa Limited. Right? What was the net cash flow from operating activities? So what you need to do here is you prepare the cash flow statement first. So start with operating profit. So here we are given profit before interest and depreciation, right? So operating profit, it includes profit before interest alone, but after charging depreciation. So it means on the 300,000, we need to test the depreciation. So depreciation is 20. So I need to less the depreciation. So 300 minus 20, you get 280. So you write 280,000, representing your operating profit, right? So this operating profit is profit before interest, right? But depreciation deducted, right? After that, we move on to the heading, non-cash items. So on non-cash items, we record depreciation. We also record profit or loss on disposal. So our depreciation, remember, is 20,000. So this 20,000 here is now posted as a positive, so that we add back the non-cash item which was deducted from our profit, right? So do we have profit or disposal or a loss on disposal? We do not have, right? If we have loss on disposal, you put it as a positive figure, and the profit on disposal, you deduct it. Why? Because profit on disposal was a non-cash income which increased the profit, yet it was not cash. Hence, profit on disposal is deducted, loss on disposal is added. So here we just have one non-cash item which is 20,000. So let me add. You get 300,000, right? Then we move on to another heading which is known as changes in working capital, right? So here we have to look at the change in inventories, change in trade receivables, as well as change in trade payables, right? So there was increase in inventory. So the increase in inventory reflected 40,000. So 40,000 denotes cash outflow. If we have increase in inventory, it means we have invested money in stocks. So it represents cash outflow, right? Then decrease in receivables. Decrease in receivables amounted to 20,000. So decrease in receivables, it means our debtors have settled their bills, part of their bills. So this is cash inflow. Money is coming from the debtors. Then increase in bank is not recorded under changes in working capital, but it is recorded at the last section of the cash flow statement, right? Increase in payables, we need to consider this one. It means the business, right, has obtained funds by borrowing, so this is cash inflow, right? After that, let us put the total. 35 plus 20 minus 40. You get 15,000 to be added with 300,000. It gives you 315,000. And 315,000 denotes the net cash flow from operating activities. Our option is A. So A is the answer. Right, we move on to question number 14. A company's opening inventory was overvalued by 6,000. What effect would the correction of error have on the following items, right? The first thing to note is, if a figure is overvalued, right, by 6,000, it is corrected by lessing 6,000. I hope you are following. If a figure is overvalued by 6,000, we correct that figure by lessing 6,000. I hope you are following, right? So opening stock, right, increases cost of sales. I hope you are following. The higher the opening stock, the higher the cost of sales. The lower the opening stock, the lower the cost of sales. I hope you are following, right? So if we less opening stock by 6,000, it simply means that our cost of sales are going to be deducted by 6,000. The lower the cost of sales, the higher the gross profit, which is also the higher the net profit. So it means if we correct this, our net profit is going to be increased by 6,000, since cost of sales are also deducted by 6,000. I hope you are following. Right. Then I want you to understand something. This opening stock, let's say we are in 2020, represents the closing stock of 2019. The stock that we are referring to as opening stock in 2020, I hope you are following, was previously known as the closing stock or the closing inventory in 2019, right? So the effect on the brought forward treats it as closing stock of 2019. I hope you are following. So if we less closing stock, it means retained profits are going to be deducted. I hope you are following. Because the lesser the closing stock, the lesser the profit. The higher the closing stock, the higher the profit. So it means my answer is B. Net profit is going to be increased by 6,000 since opening stock was less by 6,000. Cost of sales were also less by 6,000, increasing our gross profit, which in turn increased the net profit, right? But when we talk of retained profit, it means this opening stock SBD was also known as closing stock in 2019, which is the opposite effect. So less in closing stock is less in profit. So our answer is B. I hope you are following class. We move on to question number 15. The following information is for Tindo Sports Club for the year ended 31 December 2016. We are given subscriptions owing as well as subscriptions received in advance. During the year, the club received 15,000 for subscriptions. What is the amount for subscriptions in the income and expenditure account? So you have to prepare income and expenditure account, and the format is you have owing BD on the debit and prepaid BD on the credit side. So on the credit side you have bank or cash, which is received from the subscriptions. Then here we have what we call bad debts. If your question you have subscriptions written off as bad debts, they appear on the credit side of the subscriptions account. We also have owing CD. I hope you are following. On this debit side we have income and expenditure, the figure which we want to appear as a balancing figure here, and we have prepaid CD, something like this. I hope you are following, right? So owing BD, you take the owing for 1 January 2016 and the owing BD is 550. The owing CD is 650, so you put 650 on owing CD, right? Subscriptions received in advance, this is prepaid BD of 1,500, then 1.4 denotes prepaid CD, right? Then we received 15,000. So 15,000 is going to denote your bank. We do not have bad debts in this question. Put a dash. So I'm going to add the total on the credit side. 1,500 plus 15,000 plus 650. You get 17,150. Put 17,150 both sides. So 17,150 minus 1,400 minus 550. What do you get? 15,200. So the answer here is D. I hope you are following class. We move on to question number 16. Inventories are valued at the lower of cost and net realizable value in the statement of financial position. Which accounting concept is being applied? We are applying prudence concept. Why? Because we do not want to overvalue our stocks, which would in turn in overstating our profits. So prudent concept is the answer. I hope you are following. Consistent concept simply means that once a basis is adopted or a policy is adopted, it must be maintained from one period to another. Like if you bought your fixed asset or your motor vehicle, if you charge it in the first year with the straight line, you need to maintain straight line method from one period to another. You don't change from straight line to reducing. That's consistent. Historical cost concept simply says that assets, the price or the original price of the asset must be reflected in the statement of financial position, right? Materiality simply says that items bought for business use which have less significant value, like ashtrays, bins, or a pencil, must be treated as revenue expenditure and not as non-current assets. So our answer is prudent concept. I hope you are following, right? Then we move on to question number 17. The following inventory transactions are available for a business for the month of March, right? The business uses AFCO. AFCO is known as weighted average cost method, what was the value of the closing inventory after the transactions. I hope you are following. So this is the table that you prepare for weighted average cost. You have a column for debt. Purchases are also known as receipts. Sales are also known as issues. Then we have a balance column. Right, I hope you are following. Right, so the first transaction took place on 1 March. So I'm going to write 1 March here, or March 1. Write March 1 here. Right, what took place? Opening inventory. So we just need to put this as the opening balance. 20 items at a cost of 335. So let me multiply 20 times 335. You get 6,700. That was the only transaction for March 1. So I'm going to close. Right. Then we move on to March 4. March 4, receipts, it means we bought. So I'm going to put 34 items in the quantity for purchases. We bought at a cost of 400. So 34 times 400, you get 13,600. But I want you to notice something, class. Whenever you buy new stock, right, the average cost changes, or the average cost is altered whenever new delivery comes, right? So how do you then alter, or how do you then calculate the new AC? Quantity arrived is going to be added on the previous quantity. So 20 plus the 34, you get 54, right? Then amount of new stock, which is 13.6, is going to be added on 6.7. The previous amount, you get 20,300. So AC is the last figure to be calculated, which comes as a balancing figure. If you divide 20.3 with 54, you get 375,9259. Let me put it to 4 decimal places for degree of accuracy, right? Then I move on to March 6. Issues, 24 items. So I'm going to write 24 in the sales column. Remember, if it comes like issues 24 items at 600 each, this 600 denotes selling price. It is ignored. I want you to notice that selling price is not recorded in stock valuation here, right? So if you are given the selling price, you simply ignore it. But you have to multiply the 24 items with the new or the previous AC. And the previous AC here is 375,9259. So 375,9259 times 24. You get 9022. You put 9022. So for amount, you round off to the nearest whole number. But for AC, round to 4 decimal places for degree of accuracy. Right, so since it is representing a sale, it means 54 is going to be less by 24. You get 30. You multiply this 30 with 375,9259 times 375,9259. So you get 11,278, and this is your closing inventory. I hope you are following. Right, so my answer is C, 11,278. We move on to question number 18. It reads, a company bought a stapler, right, which had a useful life of 3 years and treated it as revenue expenditure. So this is the concept that I was just explaining on question number 16, the materiality concept. So your answer is B. Items bought for business use which are of less significant value, such as stapler, must be treated as revenue expenditure. B is your answer. Then this substance over form, it works for hire purchase, as well as leasing. So if you find a question which states hire purchase or leasing, your answer becomes substance over form. I hope you are following. We move on to question number 19. Peter, John, and James are in partnership sharing profits and losses in the ratio of 5:3:2 respectively. Peter decided to retire and his share of goodwill is 37,500, but is not to be shown in the books. Non-current assets were revalued from 400,000 to 350,000. The new profit sharing ratio will be 3:2. What is the adjustment in John's capital account? So what you need to do is you prepare 3 columns. This one is meant for the partners. This one is meant for before, which is before the retirement. And this one is the new partnership after the retirement. I hope you are following something like this. So we have 3 partners here. This is Peter, this is John, and this is James. So these are the partners, right? So remember, these questions, they normally give us the total goodwill, which we then share using the old ratios and the new ratios. But this time around, the examiner has decided to come with a different angle, right? We are given the share of goodwill for one partner only, who is Peter. So Peter decides to retire and his share of goodwill is 37.5. So I'm going to put 37,500 on Peter, but the total goodwill was not given. So to find the total goodwill, we have to use simple proportion. I hope you are following. So remember, the ratio before the retirement of Peter is 5:3:2. So 5 is close to 37,500, which is 5 the ratio for Peter. I hope you are following. To find the goodwill for John, John has a ratio of 3. 3 is close to x, then you cross multiply. So you get 5x is close to 37.5 times 3. You get 112,500. Divide this by 5. Divide by 5. X is close to 22,500. So 22.5 represent the share for John. I hope you are following. Then if 5 is close to 37,500, it means the share of James, which is 2, is also x. You cross what? Multiply. 5x is close to 37.5 times 2. You get 75,000. Divide by 5. X is close to 15,000. So the share for James is 15,000. Hence, the total goodwill represent the totals. So 15,000 plus 22.5 plus 37,500. It means the total goodwill is 75,000. So this is how you calculate the total goodwill. So take note that not all questions comes with the total goodwill. Some of the questions, they just give you the goodwill for one partner, but you have to carry out the simple proportion to find the goodwill for other partners. Then you add to find the total goodwill, which appears in the totals both sides. Now that Peter is retired, it means Peter is no longer having a share of goodwill in the after column. Here is the question. The new profit sharing ratios will be 3:2. So we now share 3:2, but for John and James. I hope you are following. So 3/5, right? 3/5 times 75,000. You get 45,000. So 45,000 is for John. Then 2/5 times 75,000. What do you get? 30,000. 30,000 is for James. So this is the adjustment. So since there is a statement that but goodwill is not to be shown in the books, So if goodwill is not to be shown in the books, the goodwills on the before are credited in the partner's capital accounts. The goodwills on the after are debited on the partner's capital accounts. So this is the adjustment if goodwill is not to be shown in the books. Then if goodwill is to be shown in the books, only before are credited and the after are not debited. Take note of that. Right. So after the adjustment of goodwill, you have to prepare a revaluation account. On the debit of the revaluation account, you record decrease in assets. On the credit of the revaluation account, you record increase in assets. So there is paragraph number 3. It reads, non-current assets were revalued from 400,000 to 350,000. So it indicates a decrease of 50. I hope you are following. So I'm going to place the non-current assets on the debit side where decrease in assets are recorded. Then you place the difference between the old balance sheet value of 400 with the revalued amount of 350. I hope you are following. So this means the balancing figure is going to come on the credit side. So a balancing figure on the credit side denotes loss on revaluation, which is shared to the capital account of old partners. It is very important to notice that revaluation account only uses old ratios, and in the revaluation account only old partners are recorded. I hope you are following. So we are going to share this 50,000 use ratio 5 as to 3 as to 2, which was the old ratio. So 3 over 10 times 50,000, what do you get? Right, you get 25,000. Then 3 over 10 times 50,000, what do you get? You get 15,000. Then 2 over 10 times 50,000, you get 10,000. I hope you are following. Right. We now move on to the question. What was the adjustment in John capital account? So we now need to prepare capital account for John only. So this is John capital account. Right, something like this. The capital account for John, it usually starts with balance BD, but we are not given the balance BD. The question just wants the adjustment made in John capital account. So remember, the goodwill in the before column are credited and the goodwill in the after column are debited. So for John in the before, we had 22.5. So I'm going to put a goodwill of 22.5 on the credit. I hope you are following, class. Then we have an after goodwill of 45. So I'm going to put 45,000 on the debit, something like this. We are done adjusting the goodwill. Then we have a loss on revaluation for John of 15,000. So since it is on the credit in the capital account, it is debited to complete double entry. So loss on revaluation 15,000, something like this. So what is the net adjustment? 45 plus 15, you get 60. Then 60,000 minus 22.5 is the net adjustment. So 60,000 minus 22.5, you get 37,500. I hope you are following. And this 37,500 is representing more of a CD. If it is brought down, you get 37,500. So the net adjustment is 37,500, but debit. So where is the answer? Right. 37,500 debit. My answer is D. The following events occurred after the year end. Right? These are post-balance sheet events. but before the financial statements were approved by directors. Which of these is an adjusting event? So an adjusting event is a post-balance sheet event which occurs before the balance sheet date. I hope you are following. Right. A is the answer. A major trade receivables becoming bankrupt, but the rest, they denote non-adjusting event. Right. Why A is an adjusting event? Right. If a debtor becomes insolvent, let's say we are in 2020, someone buys in April goods worth 20,000, and we found that next year, which is 2021, or at the close of the balance sheet date, or next year in January, we found that the debtor is now insolvent, and we want to write the debtor as a bad debt. It is an adjusting event. Why? Because the transaction took place in 2020 and not after 2020. That's why debtors that are insolvent are treated as adjusting event. Why? Because an adjusting event is a post-balance sheet event which occurs before the balance sheet date and not after the balance sheet date. We move on to question number 21. A company purchases the business of a sole trader for 150,000. So 150,000 is known as the purchase consideration or the purchase price. How much was paid in cash? So what you need to do is you simply prepare the purchase consideration summary. Then you put the 150,000 in the total, something like this. So it was satisfied in three ways. Way number one, we had ordinary shares. We also have a share premium. So we have two items in the first satisfaction. So 80,000 times a dollar, you have 80,000. Then 80,000 times 50 cents, you have a premium of 40,000. Then you move on to entry number 2, which is debenture. Since it was at par, it simply means that we record this 10,000. I hope you are following class. Right. Then the question says, the balance of the purchase price was settled in cash. So cash is going to come out here as a balancing figure. So 150 minus 10 minus 40 minus 80, you get 20,000. So 20,000 is the balancing figure. My answer is A. Right. We move on to question number 22. The following is an extract of the statement of financial position of a company. What is the value of each ordinary shares based on the statement of financial position? Right. So the value of each ordinary share, also known as fair value, it is found by the formula equity divided by number of ordinary shares. I hope you are following. So equity is made up of reserves plus ordinary share capital. So ordinary shares are amounting to 500,000. They are part of the equity. Preference are part of FCC, not equity. Share premium is a reserve. So I'm going to include 400,000 in the equity. General reserve is also included, 300,000. Revaluation reserve of 100,000 is also considered. Retained income of 600,000 is also considered. Then you need to divide by the number of ordinary shares, which are found by dividing this 500 with the dollar, and they are also given as 500,000 here. So you divide by 500,000. So 5 plus 4, you get 9. 9 plus 3, you get 12. 12 plus 1, you get 13. Right? 13 plus 6, you get 19. So I'm going to write 19 and put 5 zeros in front. Then divide this by 500,000. The zeros, they cancel out each other. So 19 divided by 5, you get 3.8. So the answer is C, $3.80, which is our fair value. We move on to question number 23. Right, I hope you are following class. Right, it reads, a company has been liquidated and only remaining assets realized 60,000. Right. So according to the distribution of the 60,000, we give first preference to the loan stockholders. After loan stockholders are fully paid, we consider preference shares, and lastly, ordinary shares. They take highest risk since they are owners of the company. So it simply means that this 20,000 is going to be paid in full, and you'll be left with the 40,000 from this 60. I hope you are following. Then 40,000 is sufficient enough to cover the entire amount for preference shares. So this 30,000 for preference is also going to be paid off, and we are now left with the 10,000, which is insufficient to cover the 50,000 for the ordinary shares. So if we cover part of the ordinary shares, you'll be left with the 40,000 balance for ordinary shares, but the rest holders will be covered. I hope you are following. Right. So what is the answer here? How will the 60,000 be distributed? I hope you are following. So it means 20,000 is going to be given to loan stockholders in full. 30,000 here is going to be given to preference shares in full, and only 10,000 will be given to ordinary shares. So the answer is B. We move on to question number 24. It reads, a company sells goods on a sale or return basis. Remember, sale or return basis, we do not treat the goods as sales according to realization concept, because the customer has not intended or made an intention to buy the goods. Right, on a markup of 33 and 30%. On the statement of financial position date, the following information is available. Goods in warehouse at cost 400,000. Goods sent on a sale return basis at invoice price 240,000. What will be the value of closing inventory? So remember, goods that are sent on a sale return basis are going to be part of this business stock. Why? Because they have not yet been sold. So it means this 240 is at selling price. We need to remove the profit margin so that we calculate the cost of those goods and add them to the 400 to find the required closing inventory value. So sales or selling price minus what? Selling price minus margin. You get your cost price. So the selling price of those goods is 240,000. We need to less margin. So we are given markup as 33 and 30%, which is simply as 1/3 as a fraction in its lowest terms. So how do you find margin? You add 1 on 3. You add the numerator on the denominator. I hope you are following. You get 1/4, and 1/4 times 100, it gives you 25%. So I'm going to less 25% from 240,000 to find the cost price of the goods sent on a sale return basis. So 240,000 minus 25%, you get 18,000. But you get 180,000. 240,000 minus 25%, you get 180,000. But I want you to notice how you punch this in your calculator. You punch 240,000 first, then you punch minus, you put 25, right? Then the second function, you punch 1. This is how you obtain 180,000. So 180,000 is going to be added with the 400,000. You get 580. So my answer is A. We move on to question number 25. The purchase of a computer for use in the business had been treated as revenue expenditure. What is the effect on assets and on profits? So if we treat the asset as revenue expenditure, we increase expenses. And expenses have an effect of understating our profits. So my answer is between B and D. I hope you are following. Our profits are going to be understated by increasing expenses, right? But treating a non-current asset as an expense, it means our assets are going to be understated. I hope you are following. So my answer is D. We are going to understate our assets by not recording the computers in the assets. And we are going to understate our profits by overstating expenses. So the answer is D. We move on to question number 26. Which of the following must be included in the director's report of a company? A. Accounting policy. Amount recommended to be paid as dividends. Director's remuneration. Inventory valuation policy. So the answer is B. Amount recommended to be paid as dividends. Right, we move on to question number 27. It reads, the following is an extract from the statement of financial position of a company. What is the maximum number of bonus shares that could be legally issued? So remember, bonus shares are financed by reserves. So the total reserves simply means the maximum bonus that we can issue in terms of the value. Right, so we have share premium, general reserve, and retained income. With a total of 6 plus 3, you get 9. 9 plus 2, you get 11. So the maximum bonus value that we have is 11,000. And since our par value is dollar, it simply means the number of bonus that we can issue is 11,000. Since bonus is issued at par value. So my answer is D. I hope you are following. Then we move on to question number 28. It reads, information from a partnership account is shown. Which profit figure is to be shared between partners? Right, so we have 20,000, which is representing the profit before interest. So we need to remove interest. So interest on partners' loan to the firm is 1,000. So I'm going to remove 1,000 so that I get the net profit after deducting the interest. So you'll be left with 19,000. I hope you are following. Right, so this 19,000 denotes the net profit. On the net profit, interest on drawings are added. Interest on drawings are added. So we are going to add interest on drawings of 3,000, making it a total of 22,000. Right, then drawings are not part of the appropriation account. We just record interest on drawings and less interest on capital. So the appropriation is going to have a balance of profits of 22,000. A is our answer. We move on to question number 29. Which ratio represents a company which is operating in a very competitive market? So if we are operating in a very competitive market, it simply means that our gross profit percentage is going to be very low since they are competitors, right? So this is note number 1. Then the trade receivables collection period is going to be higher since companies, they try to compete by giving more grace period to clients in order to attract more clients. You give them more grace period so that we have more clients coming on your way. So my answer is between A and B. Why? Because on A and B we have a lower gross profit percentage. Right. Then I'm going to take B as the best answer. Why? because B has got a higher trade receivables collection period, giving us more grace period to debtors to settle off their bills, we attract more people. So B becomes your answer. We move on to question number 30. The table shows an extract from a trial balance as at 31 December 2017. A sales invoice for goods sold on 1 November 2017 for 700 was omitted from the books. Which figure for current assets would appear in the statement of financial position? So on the trade receivable side, you simply take this 40,000, right? Do not take the difference between 40 and 5. You just take the 40,000. The 40,000 is recorded in the current assets, and this one is a current liability. Same applies. For trade receivables, you just need to take this 1,000. It means that our business made an overpayment to suppliers, and we are yet to be refunded by our suppliers. So in this table, we have 41,000 current assets alone for that table. But there was an omission of credit sale. A sales invoice was omitted. It means there is a debtor owing us 700 who was not recorded. So it means 41,000 plus 700, we get a total of 41,700 as current assets. I hope you are following. Ignore this credit column. Right. Then we move on to question number 13. In marginal costing, which cost is used to value finished inventory? Remember, finished inventory are valued at variable cost of production. So the answer is C. Then we move on to question number 32, which is in line with cash budget, right? So when preparing your cash budget, you put your totals here to record. You have January, you have Feb, and you have March, something like this. So the cash sales are given as 20,000, 20,000, and 20,000. So cash sales are recorded in the cash budget in the same month in which goods were sold. So we don't have problems with the first row. Then we are also given the credit sales. The credit sales, we have 35,000. We have 45,000. We also have 55,000, something like this. Right. So we have two groups of debtors. Those who are paying in the following month and those who are paying 2 months after the sale. So the first group is paying in the following month, and it is paying 70% of the credit. So I'm going to use the formula times 70%. Then I'm going to put the arrows one step. So 35,000 times 70%, you get 24,500, which is a payment to be received in February. Then 45,000 times 70%, what do you get? You get 31.5, a payment to be received in March. Then 55,000, since it is outside the given period of March, we can simply ignore it. That we move on to group number 2. This one is paying 2 months after the sale, to be calculated by the formula times 30%. So I'm going to start with 35,000. 35,000 times the 30%, you get 10.5 to be paid 2 months after the sale. You write 10,500 here. I hope you are following. But this group is going to pay in April, which is outside the required period of March. So what is the total amount or cash received in March? We have cash sales of 20, we have 31.5 and 10.5. So this 55 is ignored. So I'm going to add 20,000 plus 31.5 plus 10.5. You get a total of 62,000. So my answer is C. I hope you are following. We move on to question number 33. A company's sales revenue for the year was 500,000. Its fixed assets amounted to 150,000 and contribution to sales ratio was 4,000. What was the profit for the year? Right. So net profit is equals to contribution, I hope you are following, less fixed cost. Net profit is equals to contribution less fixed cost. So the contribution is to be calculated first, right? So we are given the contribution to sales is 40%, right? So it simply means that contribution over sales is equals to 40 over 100. But the company's sales revenue was 500,000. It simply means that to find contribution, put X here, then put 500,000 here, aligned to 100. Then you cross what? Multiply. You get 100, X is equals to 20 million. You get 20 million. So divide 20 million by 100. You get 200,000. So 200,000 denotes the contribution. Right, so total contribution divided by total sales, they are equivalent to 40 over 100, the contribution to sales ratio. So I'm going to put 200,000 on contribution, something like this, then deduct the fixed cost. The fixed cost amounted to 150. So 200,000 minus 150, you get 50,000. So the answer is A. We move on to question number 34. Which of the following may result in an over-absorption of fixed overhead? A contractor for a job provided the following information: budgeted overheads 30, budgeted direct labor hours 3,000, and direct labor rate 30,000. Job 101 used materials costing 50 and 5 hours of direct labor. Overheads are charged on the basis of direct labor hour. So you start by calculating direct labor hour or AR, which is budgeted overheads divided by budgeted direct labor hours. So the budgeted overheads is given as 30,000. Then divide 30,000 by budgeted direct labor hours, which is given as 3,000. The zeros cancel out each other. You have an OER of $10 per labor hour, something like this. Then after that, you prepare your job quotation. You start with the direct costs on the job quotation. You start with direct materials. So direct materials are costing 50. So you write 50 here. Then you follow with the direct labor. So direct labor is $30 per hour. So 30 times 5 hours worked, you get a total direct labor of 150. If you multiply 30 and 5, you get 150. Giving you a total of 200, representing your prime cost. Then after that, you need to add overheads. And these overheads are going to be multiplied by using the OAR of $10 per labor hour times the hours worked for labor, which are 5. You get 50. 200 plus 50, you get 250. And 250 denotes production cost. And your answer is C. I hope you are following. Then move on. Tom Limited, a manufacturing company, transfers its products from the factory to warehouse at a cost of production plus 25%. Right. The provision for unrealized profit at the start of the year was 11,000. The closing inventory of finished goods was 50,000. What is the adjustment in the income statement for unrealized profit? So what you need to do is you need to deduct, or you say current provision minus the previous provision for unrealized. If there is plus, it means the income statement is debited, since increase in provision denotes an expense. If there is minus, you credit the income statement, since minus indicates other income. So the current provision is going to be found by multiplying closing inventory with margin to find the profit element. So cost plus, it means 25% is not margin, but it's markup. So convert 1/4 the 25% to become a margin. You add the numerator on the denominator. So 1/4 plus 1, you get 1/5, and 1/5 denotes your margin. So 50,000 times 1/5, you get 10,000. So 10,000 is your current provision. Deduct it from the 11,000, which is the previous provision. There is a minus 1,000, denoting decrease in provision for unrealized profit. So decrease is income, so it is credited. So the answer is 1,000 credit A. I hope you are following class. The payback method of capital appraisal has an advantage of what? Your answer is C. Payback, it determines the project with less risk by considering a project with shorter payback period. I hope you are following. We move on to question number 38. A school is planning to buy a new printing machine at a cost of 30,000. The machine would lead to savings in operating costs of 10,000 annually. The machine will be sold after 3 years for 7,000. Using a discounting rate of 10%, what is the NPV? So what you need to do is you prepare your columns here. This is here. This is your net cash flow. Then these are your discounting factors and your present values. So you start with year 0. Year 0, you have a negative net cash flow, which is equivalent to the initial outlay of the project. In year 0, the discounting factor is always 1. So the present value comes as 30,000. Then we are anticipating a savings in annual operating costs of 10,000. You put 10,000 here. Then what is the discounting factor for year 1? It is given here 0.9091. So I'm going to multiply this by 10,000. 0.9091 times 10,000. You get 91. Then you move on to year number 2, another saving of 10,000 to be multiplied by 0.8264. You get 8264. Then in year number 3, you don't just write 10,000, but you add 10,000 with the scrap value or the residual value of 7,000, making it a total of 17,000. Multiply this by the discounting factor of year number 3, which is 0.7513. So 0.7513 times 17,000. You get 12772,10. Then add it with 8264 plus 9091. Then deduct it from 30,000. You get 127,10 positive. So your answer is C. I hope you are following. We move on to question number 39. It reads, the table contains information provided by a company. What is the amount of overhead over or under absorbed? So the formula that you use is OAR times actual hours times actual hours. I hope you are following. Minus actual overheads. So you make use of this formula. OAR times actual hours minus actual overheads. So for OAR, you say budgeted overheads divided by budgeted hours. So budgeted overheads are given as 84,000. You write 84,000 here. You write 84,000 here. Then divide 84,000 with the budgeted hours. So budgeted machine hours, we have 6,000. So 84,000 divided by 6,000, you get $14 per machine hour. I hope you are following. Then put the $14 on OAR. Multiply this with the actual machine hours. The actual machine hours are given as 5,500. So I'm going to multiply by 5,500 here. Then you less with the actual overheads. The actual overheads are given in the last row as 92,000. I hope you are following. So 14 times 5,500, you get 77,000 minus 92,000. So 77 minus 92,000, it gives you minus 15,000. So this is under recovery of 15,000. So under recovery is good as under absorbed. So your answer is D. I hope you are following. We move on to the last question for today. It reads, the graph shows material costs and quantities, right, of a product manufactured. What do the areas W and Z represent? So this 5, it represents the standard price. This 4, it represents the actual price. This 3, it represents the standard quantity, whereas this one we have 3,5 here, which represents the actual quantity, right? So price variance for materials is calculated by the formula standard price minus actual price times actual quantity. So the standard price is 5, you write 5. The actual price is 4, you write 4. The actual quantity is between 3 and 4, which is good as 3,5. What do you get? 5 minus 4, you get 1. 1 times 3,5, you get 3,5, which is favorable. So it means W is a favorable material price variance. And it means my answer is between A and B, since A and B is favorable price variance. Right, we now want to calculate Z. Z is going to be calculated by the usage variance formula. Right, so this is SQ minus AQ times SP. Our SQ is 3, you write 3, minus our AQ is 3,5, so you write 3,5 for AQ. Our SP, this is 5 here. So 3,5 from 3, you get negative 0,5. Multiply this with 5, you get negative 2,5, which is 2,5 adverse. So this is unfavorable usage. So my answer is B, with favorable price of 3,5 and unfavorable usage of 2,5 adverse. And this brings to the end of today's episode. I hope you enjoyed today's lesson. My name is Innocent Mapanda. I encourage you that if you are watching for the first time, kindly click the subscription button below in order to support and motivate me to produce more videos. Invite as many subscribers as possible and invite more students to Innocent Mapanda tutorials so that they can also benefit from these useful tutorials before their final exams. Till we meet again, Shalom.